Okay, last time, hello everybody again. Last time we just want to make some quick review what we have done so far so that we can just move to the new topic, last thing, first thing, inventory evaluation, which is very important. It's one of the most important part of income statement because using this LIFO and FIFO methodology, the people sometimes, or the company sometimes they manipulate with the income statement itself. Now, so coming to the revision, talking about the components of income statement, we said that income statement is mainly about the revenue minus expenses. However, there's some differentiation in constructing the income statement in accordance with the GAAP and IFRS. So basically, in both cases, it is the same like revenue minus cost of goods sold, and they derive gross profit from revenue. They subtract the cost of goods sold, they derive the gross profit, and from that gross profit derivation they subtract operating expenses. Abbreviated, we call it like OPEX, like expenses that occur from operations. So those expenses are subtracted from the gross profit to get the finally operating income. And these all are the same with GAAP standards and the IFRS. So let me just make it like this to make more clear. So this is how the components of income statement is constructed, basically based on GAAP and IFRS guidelines. It is the same. However, when it comes to other things that are included in income statement, the things that I'm talking, we know that revenues are considered to be as a primary source of inflow. Primary, like they are the first where the income comes from, the revenues, like primary inflows. There are the other stuff, there are the other components of the income statement, which are called secondary source of inflows. They are separately written down, like other gains, other income gains. And of course, there's other expenses or losses. And in here, one makes difference from the GAAP to the IFRS. In the IFRS, they say if we add, actually they say we should have added here something extraordinary items, like extraordinary item expenses. They say we should mention in here those type of expenses that not occurring frequently, like those expenses that the company does not face every year, or some periodical repetition that expenses incur. So the example of this extraordinary item expenses are can be give an example like earthquake. We know that the earthquake are something extraordinary, something does not happen on a regular basis, on a frequently basis. So GAAP says this type of expenses, something that comes on extraordinary basis, should be added on a separate as a separate component. This is what the GAAP says. However, according to IFRS guidelines, they say that there shouldn't be something called extraordinary items. All these extraordinary events that occurs, they should be included in here, in other expenses and losses, if there is some expenses. So until this point, GAAP and IFRS, they go same. But when it comes after adding other income gains and the other expense losses, this makes a differentiation between the GAAP and the IFRS in constructing income statement. And of course, at the end, in both cases, we are deriving a net profit, or sometimes we call it, as you know, net income, or sometimes it can be called as bottom line. So these words are used interchangeably. Bottom line. So whatever is derived, like basic components in here, all revenues minus all expenses will get you to the bottom line, will get you to the net profit. This is what the main idea about it. So this is, we can say, is all about the revision of how the income statement is constructed. However, one thing the last time I forgot to mention, I was just evaluating my lecturing, and I realized that I have not mentioned the important point, the reporting the income statement by the companies. So reporting income statement. Let's say there is a parent company that has got subsidiaries like sub 1, sub 2, and sub 3. Like this company, this parent company has got 3 subsidiaries, okay? This company has got 3 subsidiaries. In sub 1, it shows the ownership of 100%. Like the parent owns the subsidiary for 100%. The subsidiary 2, the same. It owns this subsidiary for 100%. So, and when it comes to subsidiary 3, it just owns, let's say, for 80% of it. So when it comes to the reporting of the income statement is always done on consolidated basis, on consolidation. On consolidation basis. So I think there is no problem with understanding what is the consolidation and non-consolidation income statement. Is there any issues related to this? Do you have any questions?
Yeah.
Okay. Consolidation, non-consolidation. Let's say we have subsidiary 1, subsidiary 2, subsidiary 3, which means branch 1, branch 2, branch 3. Like these branches, they have their own income statements. And these all income statements are firstly represented individually, separately. They are non-consolidated income statements, like they're independent from each other. They are not in one, like consolidation basically means summing up all the income statement, bringing all the income statement from all the branches together. This makes a consolidation. So if you see the income statement of the parent, it should have some unconsolidated and consolidated income statements. Sometimes they may not show unconsolidated ones, like individually for each branch. Maybe they may have 40 branches or 100 branches. Then it wouldn't be, it would be time consuming, and it would be like space consuming to put everything in the website to disclose this all information in their websites. What they just disclose, they disclose only the consolidated. If there is a request from the investor and they want to investigate separately each subsidiary, subsidiary or each branch separately, then they may request from the parent to provide this type of financial statements or the income statements. Okay, any questions? Is it clear what does it mean, consolidation and non-consolidation?
Yes, it's clear, but I have a question. So firm, they will make two bases, like consolidated and unconsolidated.
Yeah, parent firm, the parent firm who will make only the parent. These subsidiaries, they make only the non-consolidated ones, like the thing that is related to only them.
Okay.
And one more thing, as you have noticed in here, 100% ownership belongs to parent, 100% ownership belongs to parent, but only 80% of ownership belongs of subsidiary 3. Does it necessarily mean that this information should not be disclosed fully? No, all information, as the GAAP and the IFRS ask, that all information should be fully disclosed as it is, like fully ownership. Okay.
May you repeat, please? Parent company, they will make consolidate
They will disclose. They will disclose all info related to income statement as 100% for all 3 branches.
So
For
it
example,
will be consolidated.
yes, they will disclose everything. So like they will not disclose only 80% of this branch. They will disclose 100% of this branch.
Yes.
Okay.
And each subsidiary, they will make unconsolidated reporting.
In subsidiary, yes, they are unconsolidated financial
Okay.
statements. They are all independent from each other. Okay. And one thing, and these things you know, that I just want to underline, income statement as itself, it's not giving any information about the economic benefits of the company. It's just showing some accounting benefits of the company. So it does not measure any economic benefits. So for the investor to realize, to find out what is going on really in the company, what are the cash inflows, what are the cash outflows, it is better to move to cash flow statements. So once you have seen that some companies has got, put yourself into the shoes of the investor. If you realize that the investor has noticed that some specific company has got a negative net income, this does not necessarily mean that company is in a trouble. So sometimes company can manipulate with its income statement to lower their revenue. And I may ask the question from you, why the company may decide to lower the revenue, to manipulate with this, and how they can do it. We'll move, when we will move to the life and FIFO, we will see how they manipulating with it, and you will see it and you will understand better. My question, why the company would like to lower the revenue, to show the revenue is low, but in real the revenue is not low?
To pay less dividends.
Tax issues.
Tax issues, very true. The most important part is the tax issue. We know that in Europe and the US is around 40 to 50% the taxes on profit. So the lower you show, the less taxes you pay. So when we come to the life and FIFO, you will understand how they manipulate with this issue, and you will better get into these things. So on the last lecture, we discussed again about evaluation, when to recognize the revenue, like recognition of the revenue.
Professor, do you want to go to NCI, non-controlling interest as well, or we don't need to mention that?
We don't need to mention it for now.
Okay.
Okay. Thank you so much.
All right.
Come on.
Okay. Sure.
So coming to the recognition of revenue, we said last time we mentioned there are 4 methods of how to recognize your revenue. How the firms they use some 4 methods to recognize the revenue. First, we said is percentage of completion of the project. Second one, we said when it's completed method. The third one, we said is installment method. And the fourth one, cost recovery method. Cost recovery method. So these 4 methodologies are used to recognize the revenue and when to recognize the revenue. Sometimes, so I don't want to go with the examples. Do you want me to go again from the examples? Because I don't feel that I need to go. But if you say that let's go quickly over it, then we'll go.
Yes.
Okay, well, let's go quickly. No problem. Okay. Before going to the examples, I want to underline something in here very important. These last 2 methods are used mostly by real estate, last time I mentioned again, and by other companies in case when the companies cannot estimate properly their profits, their revenues they're gonna earn, and how much cost they're gonna incur in an exact amount. So this makes them to use these 2 methodologies. So coming to the first 2 methodologies, let's start quick review from this first and second one. Let me save it this. This saved. So I'm gonna upload it by the way, from this lecture, I started to record all my video, all my lecturing. So I will upload it in the Moodle as well, guys. You can reach, if you want to see and review something from the video, you can just reach it from the Moodle as well. And this screenshots.
Great.
Now, coming here to the example, assume that AA construction company has got contract to build a ship for $1,000 and reliable estimate of contract total cost is 800. So one thing I want to mention again that the first 2 method of recognition of the revenue are mostly used by the construction companies as well. Like if you go for the construction, you will see that the construction companies are using the first 2 methods. They will not use this last, third and fourth, because the cost is obvious, how much money they're gonna spend to construct something, and the revenue is obvious as well. More or less, you can see it. So they said they sell it for 1,000, and the cost is here. However, they ask you to determine each year income according to percentage of completion and the completed contract method in accordance with the US GAAP. So let me go to the byte. I don't feel to go. Here's a solution. So what we're doing here, as you can see here, guys, this is the income statement, how it's derived, how the revenue is calculated. What they do firstly, they try to calculate the percentage of cost has been incurred in the first year. 400 divided by 800, which means 50% of the total cost incurred in the first year. So that, according to this percentage completion method, we should get the revenue in the same way. We know our total revenue is equal to 1,000. Our total revenue equal to 1,000. So 50% of this 1,000 the first year is equal to $500. So coming to the second year, it is the same logic. $300 over the total cost. It is 37.5% of the total cost incurred in the first year. So this means that same logic, 37.5% should be earned in the corresponding year, which is $375. So coming to the year 2007, $100 over 800, it just give you 12.5%. So 12.5% of revenue should be earned in the corresponding year. So by this, you will construct the income statement. You have any questions?
Yeah. Can we proceed with examples? It's hard to understand.
Okay. Let me just write it down again. This. I'll close this. Wait. Screen share. Now, guys, here, the example is here. Can you see the example now?
Yeah.
Construction earns 1,000 selling the ship for 1,000, and they incur the cost of 800 to produce that ship, but they sell it for 1,000. So their revenue is $200 and net income. So what they do, they distribute their cost in this way: 400, 300, 100, and 800. Like each year, how much cost they incur to produce that ship. So so we use two methods in here to calculate. One is percentage of completion. The other one is completed contract method. So our job is to find out the income statement. To find the income statement, we need to construct the income component of the income statement. So which are here. So in 2005, 2006, 2007. In 2005, the cost was $400. In 2006, it was $300. And in 2007, it was $100. In total, it was $800. So this is the total cost. And revenue, they say that in order to calculate for the corresponding year the revenue, we should be able to identify how much percent in terms of percentages we incur the cost. So $400 divided by 800, it gives you 50% of cost. So our revenue, let me make it like this. So revenue, and this is cost. So our revenue in 2005 should be the same as the percentage of the cost was incurred. So our total income is $1,000, and the revenue of corresponding year should be the 50% of total income, which is $500. And coming to 2006 is the same logic. 300 divided by 800, it is 37.5. So 37.5% of cost was incurred in 2006. So the revenue should be earned 37.5 of total income, which is 375. And coming 2007, $100.
Profe-
Yes.
Professor, last week you did the same. Why we need to repeat that again? Alia,
I asked.
no, but we cannot like do the same lecture because of one person, no?
Okay.
Okay, just let me finish Islam this and I'll proceed and we'll go quickly.
Okay, thank you.
So $100 out of 800 is 12.5% of the cost incurred in here. So $1,000 of revenue is, if it's 1,200, it's just $125. So this is how we do. We do it revenue recognition in when it comes to percentage of completion. So coming to example in here, it's here. The right answer is given here, as you can see it, Alia. So
Okay.
this is according to GAAP and IFRS when it comes to percentage of completion. However, when it's completed contract, we can see that it is, they do not distribute their revenue every year as the cost is incurred correspondingly. What they say, when the contract is completed, we then recognize our revenue. Until the contract is completed, revenue is not recognized. When it's completed, then we will recognize. So at the end of the 2007, so in here, instead of 500, 375, 125, there will be 0, 0, 0. And in here, they will just recognize the revenue 1,800. And there will be revenue as net profit is 200. This is when it's a completed contract method. Okay?
Okay.
So moving to the installment.
Teacher, maybe we will skip it.
No, I will go quickly. I'm not going to just using the whiteboard. I will be very quick in here. So, or let's move it because still we have to go with the life on FIFA. Okay. So the examples in here, Alia and the others, if you will still have some questions, if you will go by self to review it, please do not hesitate to contact me. You can contact me and even make a call. I can go over it, but
Thank
now
you.
I will skip it. Okay. So coming to the financial analysis implication of it, as we noted previously, the firms, they recognize the revenues before the delivery, at the time of delivery, and after the delivery take the place. So different revenue recognition methods can be used within the firm. This is how we summarized everything. Like we have 4 methods. And the firm, they disclose their revenue recognition policies in their financial statement footnotes. So whenever you see the financial statement, the income statement, they've got the footnotes where you will understand which methodology they used to disclose their information. Okay. Coming to inventory expense recognition. In here, on one side, we understood how to recognize the revenue. Like there are 4 methods to recognize the revenue. And if on the other side, we have expenses that need to be recognized as well. Like you have inventories where you keep your goods and you keep with different purposes as intermediary goods, then to produce the final product, or you keep your inventory, the goods in inventory with a purpose to resell it. And when you resell it, whatever is left, like ending inventory, you have to be able to give some value on it, like to evaluate what is ending value in it. But to do that, there are 3 methods are used. One is first and FIFO, and the other one LIFO, abbreviated like first in, first out. And the other one is last in, the first out. So when it comes to the FIFO, it means like those first items that are purchased firstly, if you're about to sell something from inventory, they are the ones should go firstly. Or if you come to the LIFO, it is the last item purchased should go first item to be sold, like if you're about to sell it. So in this way, you are measuring the cost. The third method is called weighted average cost method that makes no assumption about the physical flow of inventory. It's just taking an average of the cost. And between this average, they calculate the ending value and cost of goods sold. So with some notation in here, I want you to keep in mind that in United States that the LIFO is very popular. And it is popular because of the income tax benefits. As we know that any products are exposed to the inflation. Like as the time passes, the more inflation takes the place. The products are increasing in price and everything becomes more and more. So $1 today is not equal to the $1 tomorrow. So using the LIFO, it gives you the benefit of the income tax benefit. So how they do it, we're gonna see it in examples that will make us more clear about it. And according to IFRS, LIFO last in first out is not allowed, but the GAAP is letting to do it. So let us see the example. Here we are given an example, like a firm A sells 3,500 units in year 5 at $2 per unit. So before selling something, you had in your inventory, like in year 1, you purchased 1,000 units at $1, and total value of your inventory is $1,000 in year 1. In year 2, you purchase one more 1,000 units as well, which is at $1.15, and the total value of $1,150. In year 3, and it follows, as you can see, like for 120, and as you can see, as you can realize, the price is increasing. The cost per unit is going up. So at the year 5, you have decided, or the firm has decided, to sell 3,500 units at the price of $2 per unit. However, in total, for 5 years, your total number of units are equal to 5,000 units, but you are selling 3,500 units. If your all goods, all products are identical, then which item you will sell first and at what cost? So why we need to evaluate the revenue? It is important because we need to construct the income statement. Our revenue is equal to 7,000, but what will be the cost? We know the revenue minus cost will give you the net income. So how are we gonna decide which items will go first and which item will go last? This is to answer the question. We will use three methodology. One is LIFO, the other one FIFO, or weighted average methodology. So coming to LIFO and FIFO, let me share the board with you. So in LIFO, year 1, let me just make it like this, divide by methodology. This is FIFO, first in, first out. So whatever came first, they will go out. Like, so in year 1, we received 1,000 units. And we will sell it for $1. So the cost of that unit will be $1, which is equal to $1,000. So in year 2, still we'll use 1 unit. And the price of in year 2, it was, if you check it, it was 115. The table itself, 115. In year 3, still we are using 1,000 units. If you remember, guys, we sold 3,500 units at $2, and our revenue is $7,000 now. Now we are calculating the cost to construct the income statement. And in year 3, we sold, let's say, at 0.2 in table, so 1,200. And year 4, we still left with 500 to make it 3,500 in total. We sold it at, in year 3 at 1.3, and the total it makes $675. So total cost, so cost of goods sold or total cost of goods sold according to FIFO, first in, first out, will be equal to $3,975. And if you want to see what will be the ending revenue, ending inventory, ending value inventory, well, what is left? Left 1,500 units. However, this 1,500 units comes from 2 different years. One is from year 4, the other one from year 5. So, ending inventory in year 4 was 500, left 500 only, times 1.25, because in year 4 it was 1.25. We're calculating the ending value. And in year 5, 1,000 units times 1.3. So in total, if you sum it up, you will end up with $1,925 of ending value of inventory. Ending value of inventory. Now, time came to construct the income statement. It is the revenue, which is 7,000, minus cost of goods sold, which is put it here, which is 3,975. And net income, somebody's writing, I will read the question, is equal, whatever is left in here. Net income is $3,025. In year, we use 1.3. In year 4, no, in year 4, we use 1.25. Because in year 4, oh, is it? Wait, then there is a mistake. True. Thank you, Jaras. Thank you so much. In here, 125. Then if it was 1.3, we wouldn't be able to get 675. True. In year 4, it is 1.25. And it is 625, not 650. Yes, thank you that you're following me. Now everything is okay here. Now our net income is 3,025. Okay, let me just recheck so that I don't have any mistakes in here. Okay, great. This is for FIFO. First in, first out. If I want to add one more thing in here, guys. If our tax, okay, I'll add it at the end when I calculate for LIFO. For LIFO, same thing, we're selling 3,500 units times $2, which is our revenue equal to $7,000. And in LIFO, as you know from definition, what it says, last in, first out. So whatever came lastly should be going out. So the last thing that we got, it was year 5, 1,000 units times $1.3, which is 1,300. In year 4, 1,000 unit times 1.25, 1,250. Year 4, year 3, 1,000 units times 1.12, 1,200. And year 2, which is only remaining 500 units times 1.15, and in total it makes 575. And if you calculate cost of goods sold, our total cost of goods sold will be equal to $4,325. So what you can see in here, guys, if you compare the cost of goods sold with the cost of goods of LIFO with the FIFO, it will give you some hints, some notations that when you're gonna subtract the taxes in here, the taxes will be lower because more costs are incurred, that it shows more cost in here. So the ending value of inventory is equal to $1,075. How did I calculate it? It is year 2, 500 units left times 1.15. And year 1, 1,000 units times 1. So in total, they make this amount. And if you want to calculate income statement, so revenue is equal to 7,000 minus COGS. Cost of goods sold is equal 4,325. And we will get net income. However, we get it gross profit, but I'm directly writing, assuming that there is no other operating expenses and gains and losses or extraordinary items, something like this. We're just directly getting the net income. So our net income is equal to $2,675. So as you can see, it is showing that still we're earning 7,000 in here and in here. It shows that we are earning same value. However, in terms of recognition, the revenue, in terms of recognition, the cost is differently. When you go with the LIFO, you overstate your cost where you pay less taxes. And here you understate your cost and you pay more taxes. So according to IFRS, LIFO is not allowed, it's prohibited. But FIFO, it is mostly used by IFRS, and it is more preferable to use LIFO only in the United States. This was for LIFO and FIFO. And the other one, we have average cost, average unit cost, the last one. Weighted average cost methodology. Weighted average cost. So how do we do in here? We know that what is the total value we need to calculate. Just a second. Let me just leave it this to you to solve it. I will explain to you. I want to go with a different example where it's clearly explained, and this one you will solve it and you will submit it to me then. I will save it. So this one you're gonna solve it to me. Hello. Yes, you want to say something? Any question regarding LIFO and FIFO, guys? Before I move to another example? If you don't have any questions, then let's move. What is left? Oh, just let me solve this then. Anyway, I'll solve it. So now, let me share the screen with you. Now, what we can see in here is the table is given here. To calculate the total value of it, what we need to do, we need to take total value of it, first of all. What is this an example? I will give you some homework then. Now, here guys, let me just type it here so they can see it. Total units purchased for 5 years. Total units purchased is equal to, for 5 years with 1,000, it is equal to 5,000. And when you multiply the total value of your inventory is just summation total of inventory. Let me drink the water. So we are just summing up this value. 1,000 the total value, if you sum it up, so 1,000 plus 1,150 plus 1,200 plus 150 plus 1,300. So the total value is $5,900. This is the value of your inventory. To calculate the average unit cost, we need to calculate average unit cost, which is 5,900 divided by 5,000. So 1.18. 1.18. the average unit cost is $1.18 per unit. Do you have any questions? Okay. Now, what is next? This is, you remember. Okay, I'll keep it like this. Let me just copy it so that we can just, I will share the whiteboard. So I'll put it here. So our job is to calculate, we said 3,500 units sold times 1.18. It would give you the cost of goods sold based on the average weighted average cost methodology. So which is equal to 3,500 times 1.18. So $4,130. This is cost of goods sold. So income statement. Revenue is 7,000. Cost of goods sold is 4,130. And net profit is equal to 2,970, if I'm not mistaken. If there is a mistake, correct me, please. Okay, this is how the net income derives. So there are three methods that are used to calculate FIFO, to evaluate, to come up with the cost of goods sold, using FIFO and LIFO and the weighted average cost. Let me save it. Do you have any questions? Okay, if you don't have any questions, I'm closing this. Closing this. Let me share the screen from the beginning with you. Now, okay, guys, this is the example. Unfortunately, I cannot arrange the quizzes as much as possible. So what I'm planning to do for you to do some class activities and submit it and send it by WhatsApp group, what I'm doing basically for other classes. So if you submit it for other classes, sorry, what I'm saying, I just lost my mind. Here, you need to do this, you need to solve this question now using LIFO, FIFO, and average methods. Or, you know, I will give you the, after the class, you will solve it and submit as a homework through the WhatsApp group. Just take a picture. Or you can do it in Excel, you can submit like this to me through the Excel. We've got 50 minutes left and I want to go through the article writing issue. Do you have any questions regarding this LIFO and FIFO?
No, I guess it's fine.
What about other guys?
It's clear.
Okay, some technical issue. I don't know what happened. Yeah, okay, now. Okay, now. Sorry, guys, if you heard my children, they're coming and going. Okay.
All right.
I've got 4 children, by the way. That's why it's very difficult to handle them. Okay, now.
Big family.
Coming to the article point, what we are left with the literature review. Islam, I think we're gonna meet with you personally with your group after the class, like 50 minutes to discuss. And for
Okay.
the others, guys, I want to do something to you to mention so that at the end you don't have any problems. If you don't mind, can I open one of yours article to go over it, to underline the common mistakes? Let's say Aydar and Anisa. Is it okay if I open yours?
Okay.
Yeah, it's okay.
Okay. Okay, guys. Now, literature review, like you're given the introduction is good. That's perfect. There's no problem. The way that you are, is this screen shared? Can you see it?
Yes.
Okay.
Yes, yes.
So the way that you mentioned the authors that you used is good. There is no problem. Is acceptable. Once you are mentioning, that's perfect. However, you will create for yourself a problem, like double writing the references. Like you should have used referencing using the Mendeley program. If nobody used it before, it's here. Have you used this program before?
No.
Okay, you download from the Google, just search it and download it. It's for free to install. You sign up with your email. How it helps me, for example, in here, what I realized, you have not mentioned my name.
Oh,
It's a big
sorry,
missing.
Professor. Where should?
Okay, use in one of it, because I use, like, you can use it in bank efficiency as well. I mentioned the same thing with the bank efficiency. It's not a big deal. And find article with the financial technology related to fintech.
Oh, okay, it
Find
was our.
show it to me, but the rest is okay. Okay, let's say you decided to use my article in using the liquidity relationship and non-performing loans. You said that the Faisal Life 2018 found that liquidity ratio affects positively NPL, and given some reasons for it. So instead of just writing like this, if you use the Mendeley, it's going to solve your all problems regarding the reference, the style referencing, and etc. What you do in here, you just put in here, go to references in the Word, insert citation. You press it, go to Mendeley, you go to Mendeley, you search my name, it's here, one of it, let's say this one, just I'm making up, you will, and I'll show you how to add the articles in here as well, guys, in this program. For example, you can see on the left panel, I have many articles. I added myself, so you can add yourself. It can be, it will be kind of book for you to keep all the articles in one place and to search it. You don't have to go from one folder to another folder. So for example, you select it, and at the top you can see cite. If you cite it, it cites in the format that it should be here. Can you see it?
Yes.
So it's cited. Now, at the same time, you want references to appear in the references here. For example, I want, let's say this is reference part. So I don't want to spend the time at the end to put all the references in the format that the conference asks or the journal is asking. I will directly put it. If you use Mendeley, just if you press the insert by bibliography, it will automatically put it in the way that the journal or the conference asks.
Mhm.
Okay.
Okay.
And where you can select the types of reference style here. If you go to the program, Mendeley Desktop, there is a view, citation style, and here you can search the conferences, you can search the journal. For example, for the last article that I was writing for Journal of Emerging Market Review. So my references are arranged according to this journal. Is that clear?
Yes.
So let's say
Which one is for KeyMap conference then?
yes, we can make it. No, KeyMap conference is not available. Here only the quality conferences, like those that are indexed by Scopus and Web of Science, are available.
So APA is fine for this one?
I have to check. If you send me the link, that conference that you're telling, I will check it. But what is the important in here, guys? In citation style, for example, most of conferences, they use this one, American Psychological Association, 6th edition. Or they will tell you, read the article itself, these are the commonly used citation styles. Okay? This is the name of the journal. Like more styles are available here. You can search it. American Medical, Political, Psychological, Social, etc. So it will make your job easier. Like you will not make complication in arranging the references, because references are really very important in journals requirements and the conference requirements as well. So how to search the articles in the Mendeley? Here, literature search. I go here, I type determinants of NPL. Here, all the articles that are related to non-performing loans. You can select this one, the first one, save the references, and it will be in your database that you created for yourself. So wherever you go, even if you are without computer, if you log in with the Mendeley desktop using your email, this all database will appear. So if I go to my office computer desktop and I open this Mendeley application in there and I use my email, this all database that I have in my here, it will appear there. So I will not have to upload from the beginning again. Okay. So this is how the literature review should be organized, but on average it was good. It's really nice. I liked it. And I want you to proceed with the methodology. The sample of the article is given to you. Start writing the methodology as soon as possible and send it to me. On Wednesday,
Okay.
I will tell you the deadline when you should give me, well, let me make it. So on Monday, I'm waiting the methodology from you. Okay?
Okay.
This Monday, I'm waiting from you the methodology part. Do you have any questions? Anything you want to ask? If you don't have any questions, I want to stop in here and I will
Excuse
have,
me.
yes, please.
Did you receive our literature review?
Who is talking? Anel?
No, it's Gauhar and Nasila.
Yes, I received it. I received it here, Gauhar. It's here. I received Aliya, Akjan, Gauhar, and Aididar. But where is Madiyar, Jaras?
Okay.
Where is yours, guys? I forgot about you.
Professor, I sent you an email today.
Yes, I received it. Islam, I received it today from you. I'm going to talk with you. I will open it and we'll go discussing together with this. Okay,
nice.
Jaras and Madiar, I want to meet with you tomorrow by evening time. At this time, is it okay?
Yes, that's okay. So we
Okay.
will send it tomorrow. Thank you.
Okay, send it to me tomorrow and we will meet at 7 o'clock then.
Tomorrow. Oh, okay. We don't
Okay?
have-
Jaras, Madiar, and Anel, we will meet tomorrow at 7 o'clock.
Okay.
Okay then. If you don't have any questions, thank you. And see you. So the others can end up the conference, and Islam, you can stay with Janai.
All right.
So you can stop the conferencing, guys.
Bye.
Thank you.
Bye. Take care.
Professor, I have a question. When should we finish our articles?
We should finish it before April ends, before the final exams. But
It's
with
like-
somebody else who is going to graduate this semester, they have to finish this week.
Okay. Thank you.
Okay. Okay, let's wait for others to leave.
Mhm.